Okay. Right. So welcome, colleagues, to lecture one, part B of our discussion. So basically, we are proceeding with our discussion. So we're talking about the general purpose financial statement. What information does it convey? What is the objective behind this? So obviously, I was just explaining to you guys to say, well, in the financial statement, this is what we find. This is the information that we find. So it's basically a report that outlines, about those economic resources that meet the definition of an asset, those claims that meet the definition of either a liability or an equity, and only those changes in resources and claims which meet the definition of income or expenses. I've already explained that previously in part A, so I don't want to, indulge too much into that. But now let's proceed to the next page. General purpose financial statement. So what is the purpose? What is the essential objective which we seek to achieve with financial statements? Because this is the core. So the objective of financial statements is to provide the user with useful information about a reporting entity's elements, right? So basically what I was showing you here is the same thing that I'm showing you over here. So the whole purpose behind financial statements is to give an accountability to the user with regards to what is happening in the reporting entity's assets, liabilities, equity, incomes, and expenses. That's what you see, right? Then what financial statements do we expect to see being used in regards to to reporting about the entity's elements? So we expect to see, of course, the statement of financial position, which I've already outlined about earlier on. So in the statement of financial position, we see assets, liabilities, as well as equity. Then we've got the statement of financial performance. So in the statement of financial performance is the same thing as statement of profit or loss and other comprehensive income. So the statement of financial performance, you see incomes and expenses that is conveyed there. Of course, guys, these are not the only financial statements, okay, that an entity would produce. There's what we call a cash flow statement. There's what we call the statement of changes in equity, okay? So of course, if you go to the cash flow statement, what you're simply seeing there, it's cash incomes, cash expenses. That's what is happening there. Whereas when you look at the statement of financial performance, this statement of profit or loss as well, the other comprehensive income, what you're seeing there, you're seeing a combination of both cash incomes and accrued incomes. Why am I saying that? Because when you do the financial statements, we apply, especially this one, statement of financial performance, statement of financial position, we apply what we call the accrual principle. So the accrual principle, what it entails is you record transaction as they occur, not necessarily as the actual payments are made. That's the accrual principle, right? So you can have income being promised to be paid to you at a later date in future. What that then means is you've got what we call an accrued income. And you can also have a scenario whereby you get certain things on credit. All right. Think of maybe trading stock. You bought trading stock from your creditors on credit, and you're supposed to pay them at a bit of a later stage. That means you've got what we call an accrued expense, right? So when I look at the statement of financial performance, which is statement of profit or loss and other comprehensive income to be exact, I see both combination of actual cashed or paid incomes, paid expenses, sorry. And then of course, actual received payments, and then also the ones which are promised, meaning to say those that have accrued to or accrued from. Very, very important to take note of that. Right. And then of course, now we get into, some of those important principles that you really need to know, guys. This you can be asked as a theory question. So there's what we call qualitative characteristics, right? In accounting, there's what we call qualitative characteristics and constraints. Now, with qualitative characteristics, there are two of those qualitative characteristics that you need to know. So there's what we call fundamental qualitative characteristics, and then there's what we call enhancing qualitative characteristics. Very important. So when you hear them talk of qualitative characteristics, they are talking of two, but within the umbrella of these two, there are specific characteristics of note which are definite that you need to know. All right. So for instance, when you talk of fundamental qualitative characteristics, there are two that are, describe the fundamental qualitative characteristics in detail, which is of course relevancy and faithful presentation. Now, before I even explain all of those things, you need to, okay, what is the purpose of these qualitative characteristics? What is it all about? Now, qualitative characteristics, it's those characteristics we expect to see in the annual financial statement that are presented or created by the reporting entity, right? So there are certain qualities we want to see. So one of them is fundamental qualitative characteristics, which of course entails two things. Number one, the financial information contained in the financial statements ought to have relevance. Is it relevant to the user? It ought to be faithfully presented, meaning to say that has it been presented in all honesty and truthfulness? You understand? Such that the person that is going to use this information have a certain degree of trust in what is being presented to them, for them to be able to make an informed decision making. I mean, to make an informed decision rather. See, right. And then of course, there's like what I've mentioned earlier, there's what we call enhancing qualitative characteristics, which would involve four specific attributes or characteristics, which is namely comparability, verifiability, understandability, and then of course timely basis. You understand? So that is just an addition to this. I'm going to explain what all of those things are. You just need to know those things for theory purposes. Okay, right? So fundamental qualitative characteristics, like I've already mentioned, there are two fundamental qualitative characteristics, which is relevancy, faithful presentation. Now let me explain what relevancy really is. So if information contained in the financial statement is considered to be relevant information, it simply means that such information is capable of making a difference in the decisions which are made by the users. I repeat again, if information contained in the financial statement is relevant information, it means it is capable, excuse me, of making a difference in the decisions that are made by the user. So meaning to say that relevant information is information useful to the user to make a decision about what is being presented to them. Faithful presentation simply means that the information is complete. What is it that makes the information to be complete or information to be trusted by the user? All right, in all truthfulness. So information can only be considered to be faithfully presented to the user if the information is neutral. Meaning to say there was an unbiased, unbiased mental attitude or an unbiased process that was, inducted in order to create that financial information. Number two, it means the information was created free from error. That's faithful presentation. So the neutrality or the neutralness of information, it simply means there was no influence to jeopardize what is being presented. Okay. Then if it is free from error, it means the systems that they've used to generate that information, it is up to standard. Okay. Right. So those were the fundamental qualitative characteristics of note, steps followed in applying the fundamental characteristics. So let's say now we are busy creating your financial information, right? What are those things that you need to do to ensure that these qualitative characteristics are being observed? Number one, you identify the economic phenomenon that is the potential to be useful to the user. What is the economic phenomenon useful to the potential user of the financial statement? The users, remember, their interest in the company is profitability or return on their investment. So if for them to have to get to that information of being able to assess their return on investment, what information do they really need to see from the financial statement? They need to know what income the income levels of the company are, what expenses have they incurred, and then is there any profits that this company is making? Do you understand? So that will be the economic phenomenon. And then step number 2, identify what type of information will be most relevant. So obviously the type of information that will be most relevant, it is information concerning the elements of the financial statement. That is the information that will be most relevant there. So we're talking about incomes, expenses, assets, liabilities, and equity. Step number 3, determine whether the information is available and can be faithfully presented, right? So if the information can be available and presented and faithfully presented, then obviously it means it satisfies, the faithful presentation and of course the relevancy aspect. Faithful presentation, it also implies that you have got all the relevant source documents in order for the information that you are portraying in the financial statements to be considered true or to be considered neutral, free from error. Now, I don't know why I'm thinking about this, but let me show you this on the whiteboard screen. When you're dealing with accounting, all right, and if you have been my auditing student, you might discover I've mentioned something like this, to say with the accounting process, it always starts with source documents. Then we record the information from source documents on what we call subsidiary journals. From the subsidiary journals, we structure what we call the general ledger accounts. From the general ledger accounts, we have to then have a summary of our ledger accounts in form of what we call a trial balance. From the trial balance, the last thing is the annual financial statements, which goes together with the notes to the financial statements. So this is purely accounting. What I'm showing you, colleagues, this is just basically the accounting process, how it works. Now I'm showing you this for a reason, so that you understand the applicability of those of those qualitative characteristics. So we are saying for the information that you have portrayed as a reporting entity in your annual financial statement, together with the notes, for it to be faithfully presented, all right, all of this should have been applied. I'm talking about there should be a trial balance in existence, supported by, of course, which is basically a summary of these things. But for you to have the general ledger account balances, there has to be transactions that have been captured somewhere in your records. But these transactions, for them to be considered valid, there have to be some sort of source documents, supporting documentation that is actually substantiating the truthful presentation of these transactions in your journals. All right? Very, very important, guys, to take note of that. So I was just trying to help you to understand, the essence of those qualitative characteristics that I was explaining on the slideshow. Now let's come back there. Right. Then we've got, like I mentioned earlier, part of qualitative characteristics also involves what we call enhancing qualitative characteristics. So enhancing qualitative characteristics, they are there to enhance, all right, fundamental characteristics. In other words, they are there to complement those fundamental qualitative characteristics that I've already mentioned. So what are those enhancing qualitative characteristics? It's comparative information. The information in the financial statements should be comparable. All right, it should be verifiable, understandable, and it should be done on a timely basis. Hence, you've got due dates of when the financial statements are supposed to be presented or reported or issued, publicized, so to speak, okay? So that's the timely basis element there. On the next slideshow, I begin to explain what these qualitative characteristics are. So comparability means the information allows the users to identify similarities as well as differences among items, right? Not only within the entity itself that is reporting, but also with other entities within the same industry or fraternity. So for example, if it's a gold mining entity that we are looking at, and we are looking at their annual financial statements, I can be able to use the annual financial statement of company A, compare them to those of company B in terms of maybe, for example, the return on investment for the shareholders. And then I can be able to pick up to say which company is performing better than the other, right? Stuff like that. So information in the financials should be comparable. So that's the comparability aspect. Then it should also be verifiable. All right, so that's verifiability. So if information is verifiable, it can only be verifiable if there is all supporting information available. So so verifiability, it helps them, the users of the information to be able, to have an independent assessment. And that's where auditors come in anyways, right? So auditors, to be more exact, external auditors, they are there to verify whether the information that has been conveyed by the reporting entity have been faithfully presented. That is why one of the audit opinions, if you look at the audit opinion statement, under normal circumstances, say that the annual financial statement of company X, what, have been faithfully presented in accordance to the requirements of the International Financial Reporting Standards, which is the IFRS. That is if they are giving an unqualified report, right? Stuff like that. So, but the verifiability element is now just indicating the reason why auditors are there. Okay, then it should also have the element or aspect of understandability. I mean, if information has got the element of understandability, it implies that the information is clear and concise to the user. It's easy for them to interpret what is there. I mean, if information is vague, it means you can't interpret what is happening. And therefore, you cannot make use of that information to your benefit. Then, of course, there's timeliness element. So with timeless element, it simply implies that the information should be made available on a timeless basis so that the users are able to use it in their decision making. So for instance, at the end of every annual financial period, especially with public companies, they are given, I think, 3 months from the end of the financial year for them to produce, their annual financial statements, audited financial statements to be exact. Actually, it's 6 months, but within 3 months, they should have something that have already been produced. Right. Are we still there, colleagues?
Yes.
Yes, we are here.
All right. Great stuff. I hope, are you understanding what I'm explaining to you?
Yes.
That's good. Now, the real deal. So I'm just going to lay a foundation today to one element, but I'm going to discuss the rest of the other elements from next week in detail, right? So you notice, for example, I would explain the definition of an asset, explain the definition of liability, equity, income, expenses in more details so that you really understand what these things are. I know you've maybe come across this information about what assets are, the definitions and whatnot, but maybe not from the context of what you are supposed to know in this case. For instance, if you go back to AU, so not AU, but it's FAC 2601, which is the second year financial accounting. There is a concept about the conceptual framework, but not as detailed to the level of which you are going to be dealing with it in this module. You will notice, for example, that assignment 1 that you're supposed to do, they will ask you about these things, these elements of financial statements that I'm talking about. Right. So what are these elements to the financial statements? Well, there are 5 of them. Technically 6, but anyways, I'm going to deal with the 5 according to your prescribed material. There are 6, but according to your prescribed material, they're dealing with the 5. Why am I saying 6? Because there's drawings, guys, okay? So apart from these assets, liabilities, equity, income, expenses, there's something called drawings, all right? So with drawings, obviously, we see it in the statement of changes in equity, which obviously affects the equity status of the organization. So drawings also, it's one of the elements to the financial statement, but it's not discussed in the concept or the scope of this module, okay? They're only dealing with these 5: assets, liabilities, equity, and incomes and expenses, right? So on the next slideshow, I begin to introduce you guys to the first element, which is assets, right? So what is an asset by definition, right? So an asset by definition in simple terms, and I've tried to broken it down. So why I presented it this way, it's because, for instance, for each element of the definition of an asset, you'll be asked in the context of a test or assignment to discuss, okay, each one of the elements of the asset definition before you get to the conclusion to say whether the transaction really satisfies, the amount in the transaction satisfies or meets the definition of an asset. So number one, an asset, it is a present economic resource which is controlled by the entity which have resulted from past events, resulting in a right that the company has, which could potentially produce economic benefits for them. I repeat again. So an asset is a present economic resource under the control or controlled by the entity, resulting from a past event. So we are saying this economic resource that the company has, it's as the result of a past event, which now have resulted in, all right, a right that the company now has, which could potentially produce economic benefits to the company. Now, with economic benefits and even a right, you need to understand what a right is. If we're saying that the company or a reporting entity has a right over an asset, what does it mean? So a right, it could mean a right in the sense of saying you're expecting to receive some money from the asset. It could also mean that you've got the right to be using the asset. So a right, it can mean so many things, okay? And then, of course, economic benefits is also the same thing. It can mean anything that, it can mean anything that is economic in nature, which the company can benefit from. For example, being able to, to receive money, being able to exercise the right itself. You understand? That's part of the economic benefit, right? So in the PowerPoint presentation that I have, you discover that there's footnotes I've put, okay? There's some footnotes, but here it might not show because of the way I've presented the slideshow. It might not really show to your screen as such, but anyways, on the one that I'm going to share with you guys on the WhatsApp group, you discover there'll be footnotes on the slideshow, right? Now, let's explain that first element, because you need to understand these things. This is what they'll ask you to do. So, for example, when you're dealing with a transaction in the scenario, they'll ask you to explain whether there's a present economic resource, identify it from the case scenario to say, okay, the present economic resource that the company has is this. But you cannot identify it unless you understand it. So that's why you notice that for every one of these elements, I'm going to be explaining each character attribute or the element of the definition of all of these 5 elements so that you understand them in detail, what they are, because that's what they are going to test you guys. That's what they are going to test you guys, all right? So now, let's start with the present economic resource. We finished with, right. So now, elements of financial statement, okay, we've already explained this. Now, let's talk about
economic resource.
Yeah, the economic resource part. So a present economic resource, now, this is where, for example, a right is explained. So in a present economic resource, it can be a right that the organization has, which would have potential to produce economic benefits for the entity. The economic resource in this case, it could also involve the company having the ability to receive money, to receive goods or services, to use the asset or sell the asset, and it should have potential to produce economic benefits. So if it's an economic resource, these are the things that economic resource is supposed to produce at the end of the day. If there's possibilities of us receiving money, all right, if there's a possibility of us receiving goods or services, if there's a possibility of us being able to use the asset or to sell the asset, then it means we've got an economic resource that is in place. So when you're now analyzing this in a scenario, you're looking for these things to say, okay, based on what we've read in the scenario, is there a possibility of the company receiving money? Is there a possibility of the company receiving goods or services? Because it's not always cash you can receive, okay? But it can be actual goods. Think of now in the context of inventory, right? Is the company receiving goods? That's inventory already in your mind, right? Is the company receiving a service? That's trade receivables right there, okay? When you're selling things on credit, right? And then is the company having the ability to sell the asset or to use the asset, for their benefit or for them to run their operations? Now we are thinking of property, plant, and equipment. If we see that those are the attributes that are evident in the scenario, then we know that there is a existing present economic resource. So what will be your justifications? Your justification will be to say, well, there isn't a present economic resource because the company has potential to receive this. The company has a potential to use this or to sell this, which would ultimately result in potential economic benefits flowing into the company. Then you are done with that aspect. Present economic benefit. Then we go to the next one. Controlled by the entity. Right? Remember the definition says a present economic resource controlled by the entity resulting from past events, okay? So if it is controlled by the entity, here's what it means. If the company has control, all right, over an economic resource, it simply means that they're able to direct the use of the economic resource and also they're able to obtain benefits, right, from the economic from the economic resource. So this is what attributes to the asset definition. Then of course, past event. A past event simply means that there is a historic event that took place. Okay, you will see that on the updated slideshow. I've not yet put it on this one's here, but you will see it on the updated slideshow. So if ever there's a past event, so what I'm trying to explain to you is this aspect, but I'm gonna put it on the updated slideshow for next week. You will see all of these things in writing. But basically, resulting from past event, there will be a specific date that will be given, all right, when this economic resource or an asset was procured or acquired. That's what you stipulate. So with resulting from past events, you need to have an exact date to say, no, the asset, or if it's a vehicle, the vehicle was acquired in 2019. Then you're done. So or looking at, of course, if they are present, reporting financial period is 2023, 2019, that's a past event. You see? And then if they have a right to exercise, a right, I've already explained to you that the company has a right if there's potential of them receiving money, ability to sell, ability to receive, or potential to receive economic benefits, right? So these two, normally you discuss them in combination, right? Yes, the potential to produce economic benefits. You discuss these two in combination. Then at the end of it, you need to give a conclusion, right? It might not be making sense to you for now, unless when we look at a practical example, which is something that I'm going to do with you guys from next week. But for now, I would leave you with this for today. So what we're going to do from next week, we're going to look at liabilities, equity, incomes, and expenses in that session for next week. And then we do maybe two examples from maybe past assignment, just so that you can see the applicability of this. So I'm going to cover that from next week. But for today, I would have to end it here, colleagues, because just soon after this session, I've got a text engagement that I need to enter into. But before we do that, is there anybody with questions concerning what we've just covered for today?
Sorry, Privilege. My question would just be, because when I joined, I saw the general purpose financial reporting.
Yes.
I just want you to confirm,
yes.
to rather, and then later on you spoke about IFRS, right?
Yes.
And then
Yes.
International Financial Reporting.
Yes.
So this general purpose financial reporting must be done according to the standard of the financial reporting.
No, what has to actually be compiled according to the standard of IFRS is the annual financial statements, or financial statements, so to speak.
Okay.
Yeah, because you see, with a financial report, it's a holistic account of financial activities that have taken place in the company. Think of it in the sense of the integrated report of a company. That's a financial report. So in the financial report, you've got financial statements, you've got an auditor's report, you've got the audit committee's report and stuff like that. So it encapsulates quite a number of reports within the organization, but of course, which relates to the financial activity of the company. Whereas with the financial statements is just part of a financial report. And that is the one that is done in confinement to the IFRS.
Okay. No, got it.
All right.
Thank you.
Perfect. Thank you so much. All right. Any other question, colleagues, before we finish? Or was it clear? I believe it was clear. All right. No, thank you so much, colleagues, for your time.